any economic indicator I've read, any article I've read, hasn't reported that we're in recession.
So where's it coming from then?
It's mainly coming from, a lot of it is perception. It's perception about what's happening in the housing market. Yeah, the one thing they don't talk about in the media, only 5% of the housing market is actually in foreclosure. It's only 5% of the total market. When you look at the grand scheme of things, that's not a lot. But when you look at the subprime section of that, that's where you see about 28% of subprime loans are in foreclosure. Those are where the high numbers are coming from. So when you look at the total mortgage market, the total housing market, it's only 5% of that's in default. So the thing is, the country itself, the broad economy, is not in a recession. Consumers are in a recession, and it's a little different. It's not what we call a real recession, because the GDP numbers aren't reporting it. But consumers are in a recession. I do think consumers are having a tough time. We're starting to see rising job losses. Corporations have been making profits quarter over quarter for, I don't know, maybe 16, 17 consecutive quarters. But last quarter was the first time that we actually started to see some weakness in corporate profits. That normally means job losses are getting ready to come down. You know, here in our economy, we've actually had over 50 months of consecutive job growth. We actually have a good economy, believe it or not, when you look at the numbers, when you start to break the data down. But the consumers are starting to hit into a recession because they're starting to see job losses. They're not seeing the rapid appreciation in their housing values like they saw once before. Energy prices are much, much higher than they used to be. So, I mean, all those things are sort of starting to sap into consumption. And that's where our GDP is weakening a little bit. So I think consumers are falling into a recession, but the broad-based economy is not in a recession. And one of the reasons why the broad-based economy is not in a recession is, I mean, we got a number of things that are still going good for the economy. I mean, our currency is weaker. You hear that in the media all the time. Our currency is weaker, but that's improved our exports. It's also improved some of the assets in our country. Right here in Winston-Salem, we had a German group that came in that's looking to buy property in downtown Winston. There were some Israelis that just bought property in Greensboro. And there are foreigners that are looking at properties in Raleigh and Charlotte. Why do you think they're looking at properties in our country? Because they're cheap. Yeah. When you look at the currency, when you convert that euro to a dollar, and you can get basically $1.50 for every 1 euro, well, all of a sudden, real estate in the United States looks pretty cheap. So even when you think we're getting into a point where maybe things aren't right, I mean, we got a lot of investment still coming into our country. I mean, these guys are buying properties. And the other thing that I've actually looked into, when you look at consumer spending isn't always tied to asset prices. So you hear this talk about how a lot of consumers aren't seeing the kind of rising values in their homes or the rising equity any longer. Well, that's a common myth that people stop spending when they see asset prices contract. That's a myth. When people stop spending, they stop spending when they see their wage and salary growth contract. That's when they stop spending. So that's what we have to keep our eyes on. It's not the contraction in asset prices. It's the contraction in wage and salary growth, which could potentially put the broader base economy into a recession.
Your point is very well taken, and I will not forget that there's rarely a statistic that's not skewed in some way, or just to have my eye open for that when I see.
That's a great point.
Yeah.
That's a big point. If I can make one point before I leave here tonight, you take anything away from here. That's one point I try to make everywhere I go, even on the radio. And the main reason why I go on the radio is to try to dispel some of the stuff that you guys read in the media. Some of the stuff that you see in the headlines that scare you so bad. Because we have a tendency to, whatever we read in the paper, that's what we believe. We don't actually take the time to say, what are they actually talking about here? What are they reporting on? I'll tell you one of the biggest myths that people talk about all the time, and you hear this whole thing about China all the time, and how China is just ruining this country and all the cheap products and all the cheap labor and all those kind of things. And you hear that they talk about the trade deficit and the fact that we run a deficit with other countries when it comes to trade. Well, what they don't tell you, what they don't mention in that, trade deficits only measure how goods are transferred between countries, just hard goods. So if this podium here was bought from China, this would show up in our trade. What they don't show up in, what doesn't show up in the trade deficit is intellectual capital. So let's say a company, let's say in a country they want to buy Windows. Windows is software. It's not really a good, it's more intellectual property. So that kind of stuff doesn't show up in the trade deficit. Or if a country like Germany or investors in Germany, if they come and buy a building in Winston-Salem, that doesn't show up in the trade deficit. So it's not an accurate reporting of how we're really trading with companies because they don't show, everything doesn't show up. But when you hear that political headline, it scares some people. It makes them afraid of what's going on. It makes them afraid of globalization when they should really be embracing it. But they're not looking deep enough into the numbers to figure out what's really going on. You know, they don't talk about the fact that America subsidizes the research and development in the entire world. We spend so much money researching drugs and technology right here in our country. We are the innovation capital of the world. And they just don't talk about it, and it definitely doesn't show up in some of our trade numbers as well. So that's a great point. I mean, when you see these things in the media, when you read things in a magazine, when you hear it on the 6 o'clock news, if you hear statistics, figure out what it means, because a lot of times those are tools, political tools, in order to get you to go one direction or another.
Yeah.
If you would, Mr. Cash, let everyone know when you're on 97.1.
Yeah, every Tuesday I'm on 97 with Busta. I normally go in around 3, and I'm there for a couple hours. Every third week I go on Wednesday, though. I have a board meeting on Tuesday that they just won't let me out of. So every third week it's Wednesday, and then every second Saturday I do Community Focus with Renee Vaughn. If you're up at 6 o'clock on Saturday morning, tune in, call in. We always looking to have a lively chat in the morning, especially to keep me woke so you don't hear me fall asleep on the radio on Saturday morning. Yeah, that's a great question. The average stock market, the average company in the stock market will probably return about 6 to 8%. I mean, that's the average company. You know, the market in itself, the index in the market probably does about 8 to 10%. So if you were going to invest in just the S&P 500 index, you weren't going to do any active investing. You're just going to place it in that index. You're probably somewhere in the neighborhood of 8 to 10%, depending on when you got into the market. So I mean, our investments, I mean, they're making a lot more than that. I mean, when I mentioned the 15% before, that's just their preferred return. You know, when you really start looking at cash on cash return, basically looking at how much cash am I giving you back for the cash that you've given me. I mean, a lot of these guys are making 50% of their money. So I mean, the returns that you can get from going into a real estate deal can be tremendous, because not only are you getting that 15% preferred return that I just mentioned, but also at the end of the day, when we've done the deal and we've returned all the capital back to the investors, well, sometimes there's money left over, or there should be money left over. We did a good job of managing the investment. Well, all of our investors get 80% of the money that's left over. And this is another thing. This is the reason why we're incentivized to work. The way we get paid off the fund, we get a management fee off the fund for managing the assets, which is typically 1.5% of however much capital we have outstanding. But we also get 20% of the upside. So the investors get 80%, we get 20%. That's how we make our money. So we don't make any money at Wharton Gladden until we return all your money back to you.
What time frame?
Normally about a 5 to 7 year time horizon. About 5 to, and we're an opportunistic group, so we try not to be too linked to time frames, because we want to make sure we take advantage of opportunities. But it's normally 5 to 7 years. But we get 20%, you get 80%. That's our incentive to work hard for you as an investment manager. We want that pie to be as big as possible, because that's where we pull our 20% from. And then we take the other 80% and we distribute it down to the investors. But you know, some of these guys are making cash on cash returns of about 50%.
What are some of the downsides?
I can't say that. You know, some of the downsides, it's a little more riskier, honestly. A little bit more riskier investing than if you were to just go straight to buying in Google or buying Coca-Cola stock or something like that. But the guys that invest with us are looking for a bigger return. And that's how it works. I mean, if you want a big return, you're going to take more risk. You know, like hedge funds, if you hear about hedge funds, those guys have a higher potential of going out of business because it is a riskier style of investment. The other thing is we're not regulated by the SEC, so the Securities and Exchange Commission doesn't oversee any of our activities. So in a sense, it could be a lot easier for us to defraud you, to be honest with you, because we don't have a regulatory body that oversees us. So it's a greater probability that fraud can creep into the market because you don't have a regulatory body. But you know, I mean, you hear about some of those things every now and then. But you know, you as an investor, like I just mentioned to the young lady here to the right about buying a house, if if you're gonna make an investment, you've gotta be willing to educate yourself too. I mean, I'm gonna try to do a good job of educating you about what we're doing, but you've gotta educate yourself, you gotta check us out, you gotta do your homework on us and make sure you're getting in bed with someone that can do what they say they can do. All right, thank you guys once again. I really enjoyed this.